CBS News financial contributor Mellody Hobson is here to discuss. Welcome.
Hello.
So, all right, this comes after a historic year for the stock market. One of the things I've been doing over the last couple of hours is telling people perspective. The market is up almost 30% in the last year.
Correct.
This 4% drop, put that in perspective.
So it's back to where we were in mid-December. That's just one way to think about it, which was like 10 minutes ago.
Right.
The other perspective that is so important is that all of the headlines are saying biggest one-day drop, but in percentage terms, it's not even in the top 20. So we need to understand this was not a great day in the market. There's no question about it. But relative to other bad days, it doesn't even rate in the top 20.
So people like me who don't know much about the stock market, I see something like that and I hear the word correction and I wonder, is this a correction or is this something that's leading to what they call a correction, or can we just ignore it?
So one, let's define correction.
Right.
Correction is 10%, at least 10% drop in the market, at least a 10% drop. We're not at a correction yet. We're at about 8.5%. We're close, so it's more than possible. The other thing about a correction, if you look over history, I looked at 125 years of stock market returns. On average, there has been a correction about once a year. We haven't had one since 2008.
All right.
So it's been a long time, and as that old saying goes, trees do not grow to the sky. They don't. We got close to the sky, but they don't grow to the sky. So it was more than logical, and it has been expected for some time that the market would pull back. So a lot of institutional investors expected this. This can't go on forever. If I were a regular person thinking about this, this is not something to panic over.
You know, it's also very counterintuitive, right, Mellody? I mean, a lot of people, and this is partly due to the fact that the President of the United States loves to tout the stock market returns in addition to talking about the strong economy. And what that does for people is it equates the two. It says the market, the economy, going up, things are good. But in fact, the reason that the stock market is pulling back a bit is because the economy is doing so well.
It's because things are so good that the market pulled back. And I know that is totally counterintuitive. But we had a jobs report on Friday, and it told us that we're basically at full employment. Unemployment, it's 4.1%. We also saw wages go up about 3%. We have not had any wage inflation. So all of a sudden, the inflation word is out there, which means if there's inflation, companies are going to have lower profits, which means the Federal Reserve is going to also try to keep inflation in check by raising interest rates. That gets people a bit worried, and we see some of the froth come out of the market. And that's exactly what happened.
So speaking of the Federal Reserve, we have a new chairman, Jerome Powell. First day on the job yesterday. Welcome to the job. Everyone freaks out. What do we know about him, and could him being on the job have an impact on this?
I do not think so. Okay. So one of the things we know, he's been a member of the Federal Reserve Board since 2012. He's been in the room. So this is probably going to be, in terms of policy making, more of the same. And Janet Yellen, the former chair of the Fed, basically said that. He was very much on board with all of the decisions that were made. We had 3 interest rate hikes last year, and it was suggested we would probably see 3 to 4 this year. And so it's just a continuation of policy, small steps, and I would not expect anything radical from him.
So let's talk about practical terms for the average American investor. If you got a 401k this morning, you're a little bit bummed because you've seen that it's gone down. And if you're playing individual stocks, which most Americans don't do, but if you happen to do, are you buying into this weakness?
So first of all, if you have a 401k plan, you're pretty excited because the run has been so outstanding since 2008. Yes. So again, you've had basically 10 years of phenomenal. So that's number one. And now we've had a hiccup here, which is to be expected. If I'm a 401k investor, which I am, you do exactly what you've been doing. The great thing is you put a little bit of your paycheck away every 2 weeks. And when markets are expensive, you buy fewer shares. And when markets are cheap, you buy more. And over the long term, it's called dollar cost averaging, you average a better price. In order for that to work, you have to keep it on autopilot. So you don't want to make any big changes right now. This is not the time to change things.
Just don't even look at it.
Don't even look at it.
Yeah, that's what I do.
I always say that. I just get my statements and I throw them in my desk drawer, and every couple of years I happen to I randomly select one, like the lottery, to open up one of my statements and say, okay.
I still open them up to make sure the money is there. But over the long term, you have to just believe that the long-term trajectory of the stock market is up. The Dow is down but not out.
Okay.
Very good point.
That's good.
Mellody Hobson, as always, thank you so much.
Thanks.